Let me ask you a simple question. If I showed you the real money numbers of the average American in 2026, would you be ahead of them? Or would the truth make you uncomfortable? Because today, we are not talking about opinions. We are talking about hard data. Income, savings, debt, net worth. And by the end of this talk, you will know exactly where you stand financially and, more importantly, what that means for your future. In 2026, most people think they are doing okay with money. They have a job. They pay their bills. They survive each month. But survival is not success. The average American today is earning more than ever, yet saving less, carrying more debt, yet feeling more stressed, and working harder, yet falling further behind inflation. So today, I am going to walk you through the real money statistics of the average American in 2026. No sugarcoating, no motivation talk, just facts. And as we go through these numbers, I want you to ask yourself one honest question at every step. How do I compare? In 2026, the average American income looks stronger on paper than it did a decade ago. Paychecks are bigger. Hourly wages are higher. Salaries have gone up across many industries. At first glance, this creates the feeling that people are moving forward financially. But when you step back and look at what that income can actually buy, a very different picture appears. The real issue is not how much money is coming in, it is how far that money goes. Housing costs have climbed faster than wages in most cities. Rent and mortgage payments now take up a much larger share of monthly income than they used to. Healthcare premiums, deductibles, and out-of-pocket expenses continue to rise year after year. Even basic necessities like groceries, utilities, and insurance demand a bigger slice of the paycheck. So while income numbers may suggest progress, everyday life feels tighter. Inflation has quietly done most of the damage. When prices rise faster than income, purchasing power shrinks. That means the same lifestyle now costs more to maintain, even if earnings have increased. Many people do not feel richer because they are not. Their money is simply working harder to keep them in the same place. What once felt manageable now feels stressful, and small expenses that used to be ignored now require planning. Another hidden problem is how income growth is distributed. Averages can be misleading. A small group at the top has seen significant income gains, while millions in the middle and lower ranges have experienced only modest increases. When those numbers are blended together, they create an illusion of overall improvement. For many households, raises have barely kept pace with rising costs, and in some cases, they have fallen behind. This is why so many Americans feel financially stuck despite earning more than before. They are working full-time, often with side work added on, yet they are not building real financial security. Income alone no longer guarantees stability. It covers expenses, reduces short-term pressure, and provides comfort, but it does not automatically create progress. In 2026, income without purchasing power is just a number. What truly matters is not how much you earn, but what your income can support after inflation, taxes, and living costs are taken into account. That gap between what people earn and what their money can actually do is the quiet financial struggle shaping the lives of the average American today. In 2026, the savings situation of the average American is more fragile than most people realize. On the surface, many individuals believe they are doing fine because their bills are paid and their bank account is not at zero. But when you look at the actual numbers behind emergency savings, the picture becomes uncomfortable. A large portion of Americans have little to no money set aside for unexpected events, even while living in a high-cost, unpredictable economy. For many households, savings is not something that grows steadily. It is something that gets reset. A medical bill, a car repair, a short period of unemployment, or a sudden increase in rent can wipe out months or even years of effort in a matter of days. What makes this more concerning is that these events are not rare or extreme. They are normal parts of life, yet most people are not financially prepared for them. Part of the problem is that rising expenses have slowly crowded out the ability to save. When housing, food, transportation, insurance, and debt payments consume most of a paycheck, savings becomes whatever is left over. And too often, there is nothing left. Even people with decent incomes find themselves living close to the edge, not because they are reckless, but because the cost of maintaining a basic lifestyle keeps increasing. There is also a psychological layer to this issue. Many Americans rely on the idea that future income will solve today's problems. The assumption is that the next raise, the next job change, or the next bonus will finally make saving possible. In the meantime, emergencies are handled with credit cards or personal loans, turning short-term problems into long-term financial pressure. This creates a cycle where saving feels impossible, because past emergencies are still being paid for. The result is constant financial vulnerability. Without adequate savings, every unexpected expense feels like a crisis. Decisions become reactive instead of planned. Stress increases, and financial confidence disappears. People may appear stable from the outside, but one missed paycheck can quickly change everything. In 2026, low savings is not just a personal issue. It is a systemic reality affecting millions of households. It reflects an economy where income uncertainty is high, expenses are inflexible, and financial cushions are thin. The lack of savings is one of the clearest indicators of how exposed the average American truly is, even when everything appears normal on the surface. In 2026, debt is no longer viewed as a temporary setback for the average American. It has become a permanent part of daily life. Credit cards, auto loans, student loans, personal loans, and short-term financing options are woven into how people survive month to month. What was once meant to bridge short gaps is now used to support long-term living expenses. The most visible shift is how normalized this behavior has become. Carrying a balance on multiple credit cards no longer feels unusual. Monthly payments are treated like utility bills, something that must be paid but rarely questioned. As long as the minimum payment goes through, the debt feels manageable, even when balances continue to grow quietly in the background. High interest rates make this problem far more serious than it appears. A large portion of each payment goes toward interest, not progress. This means people can stay in debt for years without seeing meaningful reduction in what they owe. Even those who are consistent and responsible with payments often feel like they are running in place, never truly moving forward. Another major contributor is how debt has shifted from wants to needs. Credit is increasingly used to cover groceries, medical costs, car repairs, and housing-related expenses. These are not luxury purchases or impulsive spending. They are basic necessities that incomes fail to fully cover. When debt is used to survive rather than improve quality of life, it becomes a structural problem, not a personal failure. There is also a timing trap built into modern debt. Payments are spread out over long periods, creating the illusion of affordability. A purchase feels small when broken into monthly installments, but when multiple debts stack on top of each other, cash flow becomes tight. The future income that people depend on to make those payments is already spoken for before it arrives. This level of debt has deeper consequences than just financial strain. It limits flexibility, reduces options, and increases stress. Job changes become riskier. Emergencies become more damaging. Long-term goals are delayed because short-term obligations dominate every decision. In 2026, debt is not simply about owing money. It is about lost freedom. The average American is not just paying for past decisions, but financing the present at the cost of the future. And the longer this cycle continues, the harder it becomes to break away from it. In 2026, the gap between those who are building wealth and those who are not has reached a level that is impossible to ignore. The difference is no longer subtle. It shows up in housing, in lifestyle stability, and in long-term security. While a small group continues to see their net worth grow year after year, the majority of Americans are either standing still or falling behind, even while working harder than ever. Net worth tells a deeper story than income because it reflects ownership. Assets such as homes, investments, businesses, and retirement accounts quietly grow over time. For those who already have them, compounding works in the background, often without constant effort. For those without assets, there is nothing compounding. Every dollar earned is consumed by expenses, and the future depends entirely on the next paycheck. What makes this divide grow faster is access and timing. Those who were able to buy property earlier, invest earlier, or start building assets before major price increases benefited from rising values. Meanwhile, many others were locked out by high prices, high interest rates, or unstable income. As asset values climbed, entry became harder, not easier. This created a widening distance between two financial realities existing at the same time. Debt plays a major role in this imbalance. For one group, debt is often attached to assets that have the potential to grow in value. For the other, debt is attached to consumption and survival. One type of debt builds net worth over time, while the other erodes it. The outcome is predictable. One group gains leverage and flexibility, while the other carries pressure and limitation. Another factor is how financial growth compounds socially and psychologically. Those building wealth gain confidence, better options, and access to opportunities that further accelerate progress. Those stuck without assets face constant trade-offs and delayed decisions. Over time, this gap becomes self-reinforcing. Progress creates more progress, and stagnation becomes harder to escape. In 2026, the exploding net worth gap is not simply about fairness or inequality. It is about trajectory. Two people can earn similar incomes and live very different financial lives based on whether they own appreciating assets or rely solely on income. This divide shapes retirement outcomes, stress levels, and freedom of choice. The average American is not just competing against rising costs, but against a system where ownership determines who moves ahead and who remains financially stuck. In 2026, retirement no longer represents a clear finish line for the average American. It has become a moving target that keeps drifting further into the future. Many people still hope to stop working at a traditional age, but the numbers tell a different story. Rising living costs, longer life expectancy, and limited savings have reshaped what retirement looks like, and for millions, it now means working far longer than planned. One of the biggest pressures comes from the cost of daily life continuing well into later years. Housing, healthcare, and insurance do not disappear at retirement. In many cases, they increase. Medical expenses alone can absorb a significant portion of fixed income, making retirement feel risky rather than relaxing. The fear of running out of money often outweighs the desire to stop working, pushing people to delay retirement even when they feel physically and mentally ready to slow down. Another challenge is the gap between expectations and reality. Many Americans assume that retirement accounts, pensions, or government benefits will cover most expenses. In practice, these sources often fall short of maintaining a comfortable lifestyle. Years of underfunded retirement contributions, market volatility, and early withdrawals have left many accounts smaller than expected. When people finally look closely at their numbers, they realize the timeline they imagined is no longer realistic. The shift in retirement age is also influenced by changes in job structure. Traditional long-term careers with predictable benefits are less common. More people work in flexible, contract-based, or unstable roles that do not provide consistent retirement support. While this offers freedom earlier in life, it creates uncertainty later. Without guaranteed income streams, the idea of fully stepping away from work feels unsafe. There is also a psychological element at play. Work has become a form of financial security. Even when income is modest, the routine of a paycheck provides reassurance. Giving that up requires confidence in savings that many people simply do not have. As a result, retirement becomes partial or delayed, with people working out of necessity rather than choice. In 2026, pushing retirement back is not a sign of ambition or passion. It is often a sign of financial pressure. The average American is adjusting expectations, not because they want to stay in the workforce longer, but because their financial reality leaves little alternative. Retirement is no longer defined by age. It is defined by whether the numbers finally make sense. In 2026, the most important factor separating financial stability from financial stress is not income level. It is behavior. Two people can earn the same amount of money, live in the same city, and face the same economic conditions, yet end up in completely different financial positions. The difference comes down to how money is handled consistently over time. Many Americans focus heavily on earning more, believing that higher income will automatically solve financial problems. While income matters, it does not protect against poor money habits. Without control, higher earnings often lead to higher spending. As income rises, lifestyle expectations rise with it. What starts as comfort quietly becomes obligation, and the extra money disappears without creating long-term security. Behavior shows up in small, repeated decisions that rarely feel significant in the moment. How expenses are prioritized, how debt is used, and how often money is reviewed all shape financial outcomes. These patterns are not dramatic or visible, but over years they compound. Small missteps repeated consistently can create long-term pressure, just as small discipline choices can create stability. Another behavioral divide is how people respond to financial discomfort. Some react by avoiding the numbers altogether. Others face the reality of their situation, even when it is uncomfortable. This difference in response has a powerful effect. Avoidance allows problems to grow quietly. Awareness, even without immediate solutions, creates control. The willingness to look at the full picture often determines whether financial situations improve or worsen. Time also plays a critical role in behavior. Those who start making intentional money decisions earlier gain an advantage that is difficult to overcome later. Compounding does not reward urgency. It rewards consistency. Delays, even short ones, can significantly reduce long-term outcomes. This is why two people with similar opportunities can experience very different results by midlife. In 2026, behavior is the quiet force behind financial success or failure. The economy, wages, and inflation affect everyone, but personal patterns determine who adapts and who struggles. Income opens the door, but behavior decides what happens after. The average American's financial future is shaped less by what they earn and more by what they do repeatedly with what they already have. As we bring this conversation to a close, I want you to remember one thing. These numbers were never meant to discourage you. They were meant to give you clarity. Because clarity is power in personal finance. When you know where the average American stands in 2026, you finally have a real benchmark, not a guess, not a feeling, but a measurable point of comparison. Money outcomes are not random. They are the result of years of decisions, habits, and priorities playing out quietly in the background. The statistics we discussed today are not just trends. They are warnings and opportunities at the same time. Warnings about what happens when income rises, but behavior stays the same. Opportunities for those willing to be honest about where they stand. The question was never whether the economy is hard. It is. The real question is whether you are moving with intention or drifting with the average. Because average outcomes create average results. And in 2026, average is not a safe place to be financially. You do not need perfection. You need awareness, consistency, and time working in your favor. The moment you stop comparing yourself emotionally and start comparing yourself strategically, everything changes. So as you walk away from this, do not ask if you are doing better than others. Ask if your financial direction makes sense, because the future does not reward hope. It rewards preparation. And the decisions you make from this point forward will matter far more than the statistics we discussed today.